What if you could slash your monthly mortgage payment by hundreds of dollars, starting right now? For millions of people staring down a housing market that feels completely, utterly broken, that sounds like a fantasy. Well, there's a radical plan being floated in government circles to do exactly that: a 50-year mortgage. An idea so extreme it would rewrite the very definition of home ownership. But is this the key to finally affording a home, or is it a generational debt trap dressed up as help? The promise is simple and incredibly tempting: make homes affordable by stretching the debt over half a century. But when you look closer, when you actually run the numbers and peel back the political promises, you find a truth that is far more complicated and, frankly, far more shocking. Today, we're breaking down the good, the bad, and the downright ugly of this controversial plan. Is it a lifeline for a generation locked out of the market, or a financial ghost that offers the illusion of ownership while chaining you to a lifetime of debt? To understand why an idea as wild as a 50-year mortgage is even on the table, you have to understand the sheer desperation of this moment. We are living through a housing crisis that is fundamentally different from anything we've seen in generations. It's not just a crisis of numbers on a spreadsheet, it's a crisis of human hope, a quiet hollowing out of the promise that if you work hard, you can own a piece of the world for yourself. So, how did we get here? How did the dream of a home morph into a nightmare for so many? It wasn't one thing, but a slow motion car crash of economic forces. The story really starts in the ashes of the last crisis. After the 2008 financial crash, central banks around the world dropped interest rates to near zero, making money incredibly cheap. For a decade, this kept the economy humming. And if you already owned a home, it was a golden age. But for everyone else, the seeds of today's crisis were being planted. Those historically low rates fueled a housing boom. Prices started to climb slowly at first, and then all at once. Then the pandemic hit. A world in lockdown created a frantic scramble for more space. Suddenly, a home office wasn't a luxury, it was a lifeline. Mix in government stimulus, a surge in savings, and those same rock bottom interest rates, and the housing market became a bonfire. What poured gasoline on that fire was a severe lack of supply. For years, home construction simply hasn't kept up with population growth. The pandemic snarled supply chains, making materials expensive, and labor shortages made building new homes even slower. On top of that, large institutional investors armed with billions in cash started buying up single family homes, turning them into rentals and shrinking the number of houses available for regular families. The result is a landscape that is just bleak. As of the third quarter of 2025, the national median price for an existing single family home is about $426,800. In many cities, it's far, far worse. The old rule of thumb was that a home should cost around 3 to 4 times your annual income. For a huge portion of the population, that math is pure fantasy now. And it's not just the sticker price. The very tool used to cool an overheated market, raising interest rates, has become a brutal, double edged sword. To fight inflation, central banks have hiked rates aggressively. The average 30-year fixed mortgage rate, which hit a record low of 2.65% in January 2021, has spent much of the last few years hovering above 6%. Let's translate what that means for a real person. The principal and interest on a $400,000 loan at 3% is about $1,686 a month. At 6.5%, that same loan costs $2,528 a month. That's an extra $842 every single month, more than $10,000 a year. That's the difference between being a homeowner and being a permanent renter. The crunch is so bad that as of July 2025, the annual cost to own a median priced home now eats up a staggering 47% of the median household income, a level even higher than the peak before the 2008 crash. Unsurprisingly, one 2025 analysis found that nearly 75% of all US households cannot afford a median priced new home. This isn't just about numbers, it's about the human cost. It's the young couple who saved diligently only to watch the goalposts move faster than they could run. It's the essential workers, the teachers, the nurses, the firefighters who build our communities but can no longer afford to live in them, forced into punishingly long commutes. It's the gnawing anxiety of seeing your lease renewal, knowing another rent hike is coming that your salary can't match. It's a feeling that the system is rigged. The old advice to pull yourself up by your bootstraps sounds like a cruel joke when the boots themselves have been priced out of existence. Traditional solutions are failing. Just save more is a fantasy when rent and inflation eat every spare dollar. And the government's primary tool, interest rates, has created a trap. Low rates made prices explode, and high rates have crushed monthly affordability. It's from this crucible of desperation that radical ideas are born. When the system is failing this badly, people start looking for a reset button. And that brings us to this controversial proposal, the 50-year mortgage, an idea that doesn't try to fix the system, but instead proposes to stretch it to its absolute breaking point. So, with the old rulebook on fire, the hunt for a solution is frantic. Policymakers are now dusting off an idea from the fringes of finance and pushing it into the spotlight, the 50-year mortgage. On the surface, the logic is seductively simple. If people can't afford the monthly payments, just give them more time to pay. A lot more time. The idea has been championed as a revolutionary tool, with figures like FHFA Director Bill Polt under the Trump administration, calling it a complete game changer aimed at helping young people finally get a home. This isn't just a fringe concept, it's an idea being seriously explored at high levels of government. So, what exactly is it? Think of it as the difference between running a 10K and a marathon. You cover the same distance, but the pace is worlds apart. A 30-year mortgage is a brisk jog. A 50-year mortgage is a very slow walk. By stretching the amortization, the time it takes to pay off the loan, from 30 to 50 years, you're spreading the same debt over 2 extra decades. The immediate effect is the golden promise, the one big shiny good that makes this plan so appealing, a lower monthly payment. Let's run the numbers because this is the heart of the sales pitch. Say you want to buy a $500,000 home. You put down 20%, leaving you with a $400,000 mortgage at a 6.5% interest rate. On a standard 30-year mortgage, your monthly principal and interest payment is about $2,528. For many families, that's just out of reach. Now, apply the 50-year magic. That same $400,000 loan at the same 6.5% rate stretched over 50 years brings the monthly payment down to about $2,236. That's a savings of nearly $300 every single month. Think about what that means in the real world. $300 is a car payment. It's a week of groceries. It's the student loan bill. For many households, that $300 isn't just extra cash. It's the difference between getting approved for a loan and getting rejected. It's the difference between burning money on rent and starting to build a future. This is the core appeal. Lower the barrier to entry and make homeownership mathematically possible again. Proponents argue this could unlock the door for a new generation of first-time homebuyers who are stuck in a vicious cycle. They can't save for a down payment because rent is too high, and they can't get a mortgage because payments are too high. The 50-year mortgage, in theory, breaks this cycle. It offers a foothold on the property ladder. The thinking is it's better to be on the ladder even on the lowest rung than stuck on the ground. There's a psychological victory, too. The modern house hunt is a meat grinder for morale. A 50-year mortgage offers an escape from that cycle of disappointment. It presents a tangible path forward, a way to finally say, we did it. Finally, supporters might draw a historical parallel. The 30-year mortgage, the bedrock of the market today, was itself a radical government innovation. The foundations were laid by the Roosevelt administration's New Deal programs to combat the Great Depression, when mortgages were often short-term with huge final payments. The fully standardized 30-year loan that became the American standard after World War II fundamentally democratized housing and helped create the middle class. Proponents are essentially asking, isn't it time for the next evolution to meet the crisis of our time? In a world of impossible choices, the 50-year mortgage presents itself as a possible one. It whispers a message of hope for just a few $100s less per month. But like any deal that sounds too good to be true, you have to read the fine print. And when you do, that beautiful music starts to sound dangerously out of tune. The promise of a lower monthly payment is the shiny lure on the hook. But once that hook is set, you discover the steel line attached to it, a line that stretches for half a century and pulls you into a sea of debt so deep it's hard to comprehend. This is the bad part. First and most devastating is the interest rate nightmare. It's simple math. The longer you take to pay back a loan, the more interest you pay. In this case, the difference isn't just a little more, it's a life-altering amount of money. Let's go back to our example. That $400,000 loan at 6.5% interest. With the standard 30-year mortgage, your payment is $2,528 a month. Over those 30 years, you'll pay a total of about $910,000. That's your original $400,000, plus a staggering $510,000 in interest. A tough pill to swallow. Now, the 50-year mortgage. Your payment is a more comfortable $2,236, But because you're paying for an extra 20 years, the total amount you pay is a mind boggling $1,341,600. That's your original $400,000 plus an astronomical $941,600 in interest. Let me repeat that. To save about $300 a month, you end up paying an extra $431,600 in interest. That is more than the original loan itself. You are essentially buying your house and then buying the bank a house too. It is a colossal transfer of wealth from your family's future to a lender's balance sheet. This leads directly to the second bad, the equity trap. Equity is the portion of your home you actually own. It's the magic of home ownership, what transforms your house into a powerful financial asset. It's the cornerstone of your net worth. With a 50-year mortgage, you build equity at a glacial pace. In the early years of any long-term loan, the vast majority of your payment goes to interest, not principal. The longer the loan, the more extreme this becomes. For the first decade, maybe even two, you are effectively a renter in your own home. You make a payment every single month, but the needle on your ownership stake barely moves. You have all the responsibilities of a homeowner, the repairs, the taxes, the leaky roof, but almost none of the financial rewards. This equity trap has real world consequences. First, you're stuck paying private mortgage insurance, PMI, for much, much longer. That's the extra fee you pay when you have less than 20% equity, and it could last for 15 or 20 years instead of 7 to 10. Second, it cripples your financial flexibility. Need to replace the furnace or face a medical bill? Homeowners with equity can tap into it. If you have no equity, you have no emergency fund locked in your walls. Third, it makes it incredibly hard to move. If you need to sell your home in the first 10 or 15 years, you could find that after paying commissions and closing costs, you walk away with almost nothing or even owe money. This is called being underwater, and a 50-year loan dramatically increases that risk. Finally, and most frighteningly, the 50-year mortgage sets up a retirement catastrophe. A 30-year mortgage is designed to align with your working life. You buy a home in your 30s and make the final payment around when you retire. Now, project the 50-year timeline. If you buy your first home at age 35, you will be 85 years old when you make your final mortgage payment. Let that sink in. At an age when you should be enjoying your golden years, you'd still be tethered to a house payment. Can you afford that on a fixed income? It turns the dream of a secure retirement into a financial tightrope walk over a chasm of debt. It's not a foundation for the future. It's a blueprint for passing debt, not wealth, to your children. The good is a short-term illusion. The bad is a long-term mathematical certainty. It's a deal that trades a little monthly relief for a lifetime of financial servitude. We've established that the 50-year mortgage is a bad deal for you, but the problems don't stop at your front door. When you zoom out and look at the impact on the entire housing market, the picture gets even worse. This is where we move from the bad to the ugly. The first immediate ugly consequence is that this plan would be like pouring gasoline on the raging fire of the housing market. It would almost certainly make home prices even higher. How? Simple supply and demand. The root problem of the crisis is not that monthly payments are too high. That's a symptom. The problem is that houses cost too much because there are too many buyers chasing too few homes. A 50-year mortgage does nothing to build a single new house. It doesn't rezone a single neighborhood. All it does is artificially inflate demand. By lowering the monthly payment, you suddenly allow millions of new buyers into the market and allow existing buyers to qualify for bigger loans. What happens when you have a surge of newly empowered bidders all fighting over the same limited number of homes? Prices skyrocket. It's an iron law of economics. A seller isn't going to take $400,000 when buyers with 50-year loans can now afford to offer $450,000. The result is a vicious feedback loop. A policy meant to make housing more affordable drives up prices, making housing less affordable. The only winners are current homeowners who see their net worth explode. The very first-time buyers this is supposed to help are ultimately forced to take on an even bigger mountain of debt. The second ugly truth is the ghost of 2008. This plan would mean gutting critical safety regulations put in place to prevent another financial meltdown. After the 2008 crash, Congress passed the Dodd-Frank Act. A key part of it was the creation of a standard for safe loans known as qualified mortgages, or QM. One of the central pillars of the QM rule is a cap on the loan term. To be a standard, safe, qualified mortgage, it generally cannot be longer than 30 years. 50-year mortgage, by definition, cannot be a qualified mortgage. To implement this plan, Congress would have to change the law and declare that a half-century loan is a safe product. This would mean reintroducing massive risk into the financial system. These loans are riskier for everyone, for lenders, for the government agencies that would have to guarantee them, and for the entire market, which would become dependent on ever rising prices to prevent a wave of defaults from people with no equity. It's a return to the same house of cards mentality we were supposed to have learned from. Finally, the ugliest aspect is philosophical. It represents a cynical redefinition of home ownership. For generations, a home was the primary way for the middle class to build wealth. It was an asset you worked to pay off, one that would provide security in retirement and a legacy for your children. The 50-year mortgage destroys this ideal. It transforms home ownership from an act of wealth creation into a form of subscription-based living. Your home is no longer an asset you are on a clear path to owning. It's a service you pay for month after month, decade after decade, for your entire adult life. You're a long-term renter who has to fix the toilet. The goal is no longer to own your home, but simply to afford the payment. It's a shift from the American dream to the American subscription. This is a solution that accepts defeat. It says we can't solve the problem of high housing costs, so instead we'll create a financial instrument that normalizes and perpetuates debt across generations. That isn't just bad policy, it's ugly. So, after walking through the tempting promise, the harsh reality, and the systemic dangers, we have to ask the ultimate question. Is the 50-year mortgage the solution to the housing crisis? The verdict is clear. Absolutely not. The 50-year mortgage is not a solution. It is a financial trap disguised as a lifeline. It's a cynical gimmick that preys on the desperation of a generation priced out of the market. It offers the illusion of affordability in exchange for a reality of indentured servitude. It's a policy that wins a single battle, the monthly payment, while losing the war for long-term financial security. It burdens families with hundreds of thousands of dollars in extra interest, keeps them equity poor for decades, and puts their retirement in jeopardy. Worse, it threatens to make the crisis worse by fueling inflation and unwinding the very rules meant to protect our economy. So, if this isn't the answer, what is? The real solutions are harder. They are less politically sexy than a magic wand. The real solutions recognize that the problem isn't the length of the loan, it's the price of the house. The only way to truly solve this crisis is to fix the catastrophic imbalance between supply and demand. This means a national, all-hands-on-deck effort to build more housing. It means comprehensive zoning reform to allow for more types of homes in more neighborhoods. It means streamlining the convoluted and expensive permitting processes that kill new projects. It means investing in new construction technologies that can build homes faster and cheaper. And it means finding ways to discourage rampant speculation by large investors who turn starter homes into line items on a corporate balance sheet. These are not easy fixes. They require political courage and long-term vision, but unlike the 50-year mortgage, they are real solutions. They address the disease, not just one symptom. The 50-year mortgage is a dangerous distraction. It asks us to sacrifice our future for a pittance of relief today. We should reject it for the financial Trojan horse that it is, and instead demand our leaders focus on the hard, necessary work of building a country where everyone has a place they can afford to call home. But that's my take. It's a complex issue with a lot of passion on all sides. So, what do you think? Is this idea a last resort worth exploring, or is it a disaster waiting to happen? Would you ever sign up for a 50-year loan to get into a house today, knowing the long-term costs? Let me know your thoughts in the comments below. I read every single one, and I'm genuinely curious to hear what you think. Thanks for watching. If you found this breakdown valuable, please consider liking this video and subscribing to the channel. It helps more than you know. Until next time.